CK Friday and the soft landing. The most likely scenario for the markets bets on the end of the Fed's tightening cycle and the survival of the American economy in the fight against inflation have fueled a $2.7 trillion stock market rally in November. The S&P 500 marked its third consecutive week of gains, the longest period since July. Small-cap stocks saw their biggest rise compared to the broader market since February 2022. Global equity funds attracted $23.5 billion in the week ending November 15, the second largest inflow of the year, according to EPFR Global Data. After months of outflows, funds replicating high-yield bonds attracted nearly $11 billion and are on track for their best month of inflows ever. With 90% of companies having already reported results, S&P 500 earnings for the third quarter are on track to increase by about 4%, compared to estimates of a 1% decline a month ago. This likely indicates that the earnings recession has come to an end. While there is evidence of a soft landing this week, through a modest consumer price index report and the strength of retail spending and housing, recent history is full of similar optimism that turned out to be misplaced. According to a Bank of America survey, almost 75% of investors stated that a soft landing is their baseline scenario for the global economy in 2024. Bonds also gained this week, with two-year yields falling back below 5%. Markets are now pricing in 92 basis points of rate cuts for the next year, compared to the Fed officials' estimate of a half-point easing. The dollar had its worst week in 4 months, erasing all its 2023 gains. Oil recorded its fourth consecutive weekly decline due to supply pressures, entering a bear market, down over 20% from recent highs. Bitcoin closed lower after testing $38,000 again. Gold rose 2%, bouncing almost perfectly off its 200-period moving average. T always starts as a soft landing. We would all prefer a mild economic slowdown to a recession. The difference between the two outcomes has profound implications for asset performance. If inflation falls without heavily impacting growth, stocks will continue to thrive. In the case of a hard landing, with negative growth and rate cuts, bonds might outperform stocks. There is a consensus that inflation is on a clear downward path, and the Fed's rate hiking campaign is over. Now the question is how much economic damage the victory over inflation will cause. Let's see if history can provide some lessons. Recessions typically follow a peak in interest in the soft landing. Analyzing documents and corporate archives dating back to 1995, we find that mentions of soft landing had already occurred twice in this way. Both were followed by a recession. Soft landings are rare. According to a reasonable definition of this term, there has been only one in the last 43 years. The mid-90s remain the only clear example of a soft landing since 1980. The context of that time was much more conducive to growth than today. Continuing to examine past experience, it can be observed that bringing inflation down from 5% to 2% has not been possible without a recession. Today's drop is the largest ever recorded inflation decline without a recession. History also tells us that when unemployment rises, it really rises. This brings us to the Sahm rule, named after the economist who noted that whenever the 3-month moving average of the unemployment rate has increased by at least 0.5 percentage points from the previous 12-month low, the economy has already entered a recession. The Sahm rule indicator currently stands at 0.33%, rising toward the 0.5% threshold. According to this historically derived data, unemployment is increasing in a way that could foreshadow a recession, but we haven't reached that point yet. The case for 2 rate cuts. Now that there is a growing consensus that the Federal Reserve has finished raising interest rates, it is time to consider when policymakers will contemplate cutting rates and to what extent. It is common to think that this won't happen until inflation returns to the 2% target or until the risk of recession is high. Considering the evolution of the labor market and inflation, cutting rates by 50 basis points in the first half of 2024 would serve to preserve the expansion while maintaining at the same time a somewhat restrictive policy stance to exert downward pressure on prices. Since the last set of economic projections in September, both the labor market and inflation have performed weaker than policymakers' estimates. The unemployment rate is now at 3.9%, higher than the year-end forecast of 3.8%. This week's inflation data and the trend in recent months indicate a year-end value close to 3.5%, compared to a fourth quarter projection of 3.7% for the Fed's preferred measure, core PCE. It is reasonable to think that unemployment will increase and inflation will further slow, as Fed Chair Powell believes that monetary policy is significantly restrictive at this time. This belief stems from comparing the Fed's benchmark rate level to inflation. Using a 6-month annualized measure of core PCE, monetary policy is more restrictive than it has been in the past 16 years. As price pressures continue to ease, policy will become increasingly restrictive if the Fed does not cut rates. Policymakers will want to be somewhat proactive. By lowering rates slightly, the Fed can support expansion while maintaining a moderately restrictive approach. This is probably what it did in 2019 when it cut rates by 75 basis points even though the economy was not in a recession. Markets believe that the Fed will cut rates, perhaps as early as the March meeting, which now has about a 35% probability of a first cut. Hold no longer have the kind of concern it had in the past 2 years about inflation overheating. The recent slowdown in the labor market also means that policymakers cannot rule out a worse outcome in 2024. Policy is already restrictive and, in the eyes of the Fed, becomes increasingly so as inflation slows. The bond pivot, the bond market has turned. But the history of the past 2 years suggests that we should not jump to conclusions. In this time frame, there have been 7 attempts by bonds to reverse the trend, all of them unsuccessful. Many investors were just waiting for a good opportunity to buy. This came with October's Consumer Price Index data, which showed a slowdown in inflation. The latest survey of global fund managers conducted by Bank of America showed the greatest conviction ever recorded that long-term yields will decrease. Investors are abandoning cash to hold the largest overweight position in bonds since the global financial crisis. According to Michael Hartnett of Bank of America, the shift is not represented by macro outlooks but by expectations that inflation and yields will decrease in 2024. The belief in the peak of the Fed's interest rates is now the strongest since the survey began asking investors to time the end of the rate hiking cycle. With the Fed's stance still uncertain and a massive amount of bond issuances in the pipeline, it is too early to state that the bond bottom has been reached.